In this video, you'll learn the secret and best way to trade double tops and double bottom patterns. We'll go over the various criteria and show you real-life examples. Let's start with the double top pattern. This is a classic bearish reversal pattern that can occur at the end of an uptrend. It consists of two almost equal-sized highs that are close to one another in height and separated by a small valley. By drawing out a line at the valley, we can create our neckline. This pattern is confirmed once the asset price breaks below the neckline. You can enter a short position here and simply set your stop at your swing high. You can project the vertical distance between the neckline and the highest high downward to get your take profit targets. On the flip side, we have the double bottom pattern. This is a bullish reversal pattern. You can spot these at the end of a downtrend. Look for two bottoms around the same price with a small peak in the middle. Keep in mind that the bottoms don't have to be exactly equal, but close enough is good. Extend a line at the peak to create the neckline. When price breaks above it, that's going to be your signal to go long. Place your stop loss just below the low, then measure the distance between the neckline and the lowest low. You can then project that above the neckline for your profit targets. Now that we understand the basics of the double top and double bottom pattern, I'm going to show you some examples that you're going to be able to use in your live trading. When you're looking to trade this pattern, you need to have the right context in order for this to have a high probability of working out in your favor. So there has to be several factors that we have to have in combination with a double top pattern. On this chart, we have an uptrending market. It's consistently making higher highs and higher lows. Here, you'll notice that a double top pattern is beginning to form. Right here is the first swing high, followed by a dip in price. And then the second swing high begins to form just before it breaks the neckline. But you need to understand what makes this a good double top pattern. In this example, there are several reasons. The first is that the market has already taken out liquidity. Look to the left. This swing high was untouched for a while before the market finally broke it and traded higher. Shortly after, it made a double top. We can see how the last candle engulfed the previous candle. This is indicating bearish momentum. Price breaking below this neckline also shows that the market structure has shifted from bullish to bearish. This has created a fair value gap. We can enter a short position with our stop set just above these highs. Then project the vertical distance between the neckline and the next highest high downward. This can be used as our take profit target. Let's look at this a different way. Over here, the market took out these equal lows before moving up higher. It broke past the swing highs and established a bullish environment. So if it's bullish, logically, we should be looking for an area of support to enter a long position. Here are equal lows that have already been swept, so they'll serve as an area of support. Next, take out your Fibonacci retracement tool. You'll see that it lines up with our 618 or our golden Fibonacci retracement level. Then we just wait for the market to retrace back to this area. Here you'll see that the market was hovering above the level before it finally reached it. This initial swing low serves as the first bottom of the double bottom pattern that we're looking for. It's also an area of liquidity, so the market is more likely to take this out before moving up. Our neckline has formed at this high before it began moving down lower. The second swing low completes the double bottom pattern. Here we can enter on a break past the neckline with a candle close above it. An easy way to trade this is to set your stop loss below and aim for a level higher. Now that you have the basics and some simple examples, let's get into the secrets of the double top and double bottom trading patterns. Did you know there's actually another way that we can trade this? By simply adding in an oscillator, we can greatly increase the probabilities of winning these trades. Because by using one, we'll be able to spot divergences at these tops and bottoms. In combination, this is one of the most effective ways to identify reversals. If you don't know what divergence is, I'll explain briefly. A divergence occurs when the price of an asset and any oscillator move in opposite directions. On bullish divergence, price may make a lower low while your oscillator makes a higher low. When looking to trade the double top pattern, we'll look for bearish divergence. Price may make a higher high while our oscillator makes a lower high. It doesn't matter what oscillator you use, but for these examples, I'm going to just use a simple RSI or relative strength index. So here we can see that the market was trending down. At one point, it reached an area of support, causing it to make a small retracement. This created the first bottom and signaled our neckline. After some time, it finally takes out the first swing low and creates our double bottom pattern. Now that the low has been swept, it can also be seen as a liquidity sweep, which is an additional bullish signal for this trade. Looking down at our RSI, we can see there is a clear bullish divergence. Price has made a lower low, but RSI has made a higher low. After confirmation, we will see that the market did actually move up higher, painting higher highs, and began shifting from bearish to bullish. You can look to enter on the retest of the neckline with a stop loss set below the low and aim for levels higher. Let's move on to the double top. With this pattern, we're looking for a reversal of an already established trend. Here, the market is trending up, consistently making bullish market structure. Once it reached this area of resistance, it seemed to have trouble getting past that level. This will be our first swing high, along with our neckline. As time passed, the market began pushing up again. This second thrust completes the pattern, as it now has created a double top. Shifting our focus back to RSI, we can see that bearish divergence has begun to show itself. Price is making a higher high, but RSI did not. So simply, once it breaks past the neckline, that's your cue to go short, setting your stop just above the highs and again, targeting levels lower. Hopefully you walk away from this video with some value. And if you know another trader that might benefit from this video, please share it with them. Make sure to subscribe because we're always putting out more free trading tutorials. And leave a comment on what topic you'd like to see covered next.